The stock market rally of 2023 has stalled. Does this mean it's over or just in a holding pattern? Thanks for checking out this week's Fastest 4 Minutes in Finance. I'm Scott Inman. As of this recording, the S&P 500 index is up more than 15% year to date, but it has been sluggish in August. So in today's Fastest 4, we take a look at how a pullback may be coming. But if it happens, it does not mean you should panic. There's certainly been news that has been a driver of the market volatility in August. Fitch's downgrade of the U.S. credit rating and underwhelming economic data in China being a couple of examples. There's also the lingering uncertainty of what the Federal Reserve will do next. Even as their language has softened on the likelihood of future interest rate hikes, they still haven't officially taken their foot off the gas. In fact, a pullback would be completely normal in the market. Take a look at this chart from LPL Research. This puts S&P 500 returns from 1950 through 2022 into 10 groups based on the range of returns you see there in the middle column. On the right are the average maximum drawdowns during years with the corresponding returns. Now, all that can be a little confusing, but let's focus on the fourth row. As we mentioned, the S&P 500 is up more than 15% so far this year. If the index finished the year up between 14.6% and 19.3%, it would be normal to see a double-digit drop somewhere during the year. You can see on the chart that the average max drawdown in a year like that is 12.2%. And we haven't had that yet, and we may not. But this chart is a good reminder that it can and does happen. You can see that the pullbacks are a little more severe during years with bad market returns, but a double-digit pullback is the average for 4 of the 7 tiers that yield positive returns. Now take a look at this second chart. This one also puts the S&P 500 returns up from 1950 through 2022 and puts them into 10 groupings. In this chart, LPL focuses on the average max drawdowns in the final months of the year. So let's find our row again. 2023 would currently land in the second row. The average max drawdown from here to the end of the year would be 6.5%. Now that sounds a little better. And even better than that, the average price return during that same period is 7%. So that means in a year like this, in which we've seen the S&P surge, we could actually see a significant pullback, but finish the year even higher than we are right now. So why is that important? Well, we've gotten used to the market almost heading straight up in 2023. And that chart, both of them, are reminders that bull markets are not linear. Hopefully that helps us keep perspective when bad news drives us lower. It could just be a blip on the radar. Now, if you like keeping up to date on the market and have questions about where we are headed in the economy, we invite you to join us next week at the Chenal event venue for an evening with LPL Financial Chief Economist Dr. Jeffrey Roach. Dr. Roach has been featured on national programs and publications like CNBC, Fox Business, and U.S. News. He'll answer your questions in person on Tuesday, August 22nd at 6:30. This is a free event, but space is limited, so you need to reserve your spot. You can do that by going to getreadyforthefuture.com/economy or by calling 866-653-PLAN. That's 866-653-7526. Thanks for watching.